afternoon to one and all present here today. I, Mansi Gohil, Assistant Professor, welcome you all to the webinar series of Parul Institute of Commerce. Today we have with us Mr. Harshal Uttam Chavan, Branch Manager, Central Bank of India. Sir has completed his diploma in banking and finance, namely CAIIB. He has professional knowledge on MSME, security administration, BC, SBI, money laundering, and forex facility. So today, sir is going to talk about how the banking sector is
Hello. Well, thank you for welcoming Mansi ma'am. Good afternoon, everyone. Good afternoon, one and all. Am I audible?
yes, sir.
Okay. Shall we begin or are we waiting for two,
Yeah,
three
yeah.
more people
We
to
shall
join?
begin. Yes, sir. We shall begin.
Okay. Okay. All right. Well, I would first of all address everyone as friends because this is not a class. We are more, I would try to make it more of an interactive section with all of you. Um, Basically, banking, what is your understanding of banking? As in, I would, the question is open to all, anyone can answer it. What do you understand when you say that an institution is a bank, a financial institution is a bank? So, what are your understandings about it? Anyone, if anyone wishes to answer this? All right. See, basically, the basic definition of banking in India is any financial institution, any organization which accepts deposits from public and institutions and keeps with them, okay, for a certain period. Those are demand deposits only. All right. They should be payable on demand, and the only condition is if an institution accepts deposits to lend it out to people, okay, for a specific purpose, for a specific individual purpose, only then that institution is known as a bank. Now, in banking, basically what happens is, I would like to give a short example, the way we begin or the way we work. Okay. The thing is that, say, if a person comes in with a deposit of 100 Indian rupees, okay, I accept it, we accept those deposits, okay, basically. And after that, what happens is there are statutory requirements, regulatory capital requirements, a certain section of the deposit that we take in, we have to keep it as insurance to the government. That takes away a major chunk of the deposit, say about 60 or 70 Indian rupees. So as a bank, I'm only left with say 30 to 40 Indian rupees, okay, that I can use. Now, the people who have deposited money, okay, it can be 100 people who have deposited 1 rupee each. So at the end of the month or at the end of the quarter, half year or year, I will have to pay them interest. Now I cannot pay them interest out of the 30 rupees or 40 rupees that are remaining with me. Okay. For to be more precise, we'll consider I have 40 rupees after finishing all the statutory and regulatory capital requirements within year. Okay. So out of those 40 rupees, I cannot give, keep on giving interest to people. Okay. Even if I have to pay say 10 paisa to everyone, there are 100 people. Okay. Within 1 year, 10 rupees out of those 40 rupees is already gone. All right. This is the traditional business banking model, basically, in India. Now, what I do is I look out for people who are genuine enough, who are credible enough, who will repay if I lend them some amount, if I give them some loan. So out of the 40 rupees that I have, okay, I have given loans to say 10 people, so 4 rupees each. All right. It is their responsibility to pay me back in time. Okay. Now, the interesting part is now I'm done with the entire 100 rupees that I had with me as deposit. Okay. So now what will happen is if a certain person comes into me and says, sir, I want to withdraw my 1 rupee that I keep your deposit. Okay. Okay. So I'll have to give it back to them. All right. Uh, Suddenly, if there are 10 more people coming in, I have to pay them back as well. In this case, what will happen is the 70 rupees that I've deposited with my regulator, with RBI, with central government, okay, as of now, I will have to go back to them and ask them the money that, okay, certain deposit is asking me money, give it back to me. Okay, they won't immediately give it to me. What they'll do is, whatever money I've kept with them, they will loan that money to me. at a certain rate of interest. Okay. And I will pay my depositors from them. In the meanwhile, what will happen is the 10 people who have given the loans to, they will start repaying their EMIs. Their EMIs start from the very next month that I've given them the loan out to. In the traditional banking model, I will charge somewhere around 10% for the 4 rupees that I've given to them. So they'll start paying back 40 paisa per month. Okay. That is the revenue stream that I'm getting. All right. Now it happens that all of my loans are good. All of my 10 people are really good, really genuine. They're really paying out of their pocket, like, without defaulting on anything. Still, what my regulator, what RBI wants is that they want me, okay, to, what you can say, keep a certain section of the repayment that they have given to me, okay, as security, as caution deposit. Okay. Now that I call as provisioning. As commerce students, I presume you must have gone through this particular phrase of provisioning. Okay. It is not just the accounts that have turned bad, even standard accounts need to be provisioned in India. Okay. Or up to a certain percentage, but obvious. Okay. But I have to. It starts somewhere around 0.25% of the entire loan amount. Even if a loan is very good, it is running extremely well, the repayments are on time, the customer is very good, still I have to, as a bank, provision some of my amount. Now, if you see, the entire 100 rupees have been exhausted in the very first month itself that I have received till date. Okay. The repayments are coming in. All right. I am maintaining the regulatory capital with my regulator. Okay. And as I'm starting to get money, I eventually have to look out for more people to give money to loan out to, because again, since my bank's reputation goes up, all right, the word spreads into the market that this is a good bank, people will start coming in with the deposit. Now I cannot pardon me, I cannot, what you can say, just keep on taking deposits, because deposits, they are my liabilities. Okay, they are not my assets. I have to pay interest on it. All right, my loans are my assets because they fetch interest for me. If I'll earn 1 rupee, only then I can give out 10 paisa as interest. All right, and the 90 paisa that remains with the bank is not entirely profit. It is just gross profit. Out of that, I have to pay salaries, I have to pay rent, I have to look out for all the electricity and all the necessary bills. All right. And also, like I said, maintain capital with the regulator. In my earlier previous example that I had mentioned, that if people come to withdraw their money, okay, and don't have the money right now with them, I go back to the regulator. My regulator loans the same money to me, okay, which I had earlier kept with them as a requirement, as a regulatory requirement. And in this case, what happens is I'm again charged interest for that amount, for my very own amount. All right. In this case, out of all the 90 paisa that I'm keeping as profit, okay, I have to again pay back my regulator also, whatever money I borrowed from them to be given to depositors. This basically is a cycle that goes round and round every day, every week, every month, every year. Okay. And this will continue forever and ever and ever. This is the traditional banking model. Okay. With the basic example of 100 rupees. Now, what happens is out of the 10 people that I had given loan to, all right, 3 start saying that, sir, there are some issues, I won't be able to pay the loan, I won't be able to pay the EMIs. Okay, their loan starts getting bad. So earlier when I had mentioned that my provisioning on standard assets or standard loan accounts was 0.25% of the amount that I had given to them as loan, as their loan starts getting bad, the provisioning percentage goes on increasing. If I have given 10 rupee loan to someone, earlier I had to maintain only 25 paisa as a provisioning, that because their asset was standard, their loan was standard. Now what is going to happen is I will have to start making higher provisioning for that particular amount. Now, on one hand, that person has stopped paying me. So, like I had mentioned, the 1 rupee that I was about to get interest from them, supposed to get interest from them annually, it has completely stopped. Plus, my regulator has asked me that now what you do, Mr. Chavan, is instead of putting 25 paisa as a provisioning, now we'll step up that provisioning, and it will go on increasing with every passing year. First year, the amount will go up to 15%, which is 1.5 rupees I have to keep with my regulator as provisioning. In the meanwhile, entire 1 year, I was supposed to get 1 rupee per month from him, which means 12 rupees I should have earned in a year. I have not earned a single paisa instead of those 12 rupees, but I am also keeping a provision of 15 rupees on his loan. Okay, so this goes on increasing. Eventually, there will be a time when the entire loan amount that I had given to him would have to be provisioned with the regulator, which is RBI. Those are standard norms. And what happens is, out of of those remaining 3 or 4 people, besides those 6 or 7 people whose loans were good, whose loans were fetching me interest, now I am feeling a squeeze on my pocket. The reason being, my rent is the same, as a matter of fact, as we all know, it increases 10% to a certain percent every year. For banking branches, it is usually 5 to 15% every year, which goes on increasing after a certain number of years. We have tranches of 3 years, 5 years, 7 years, wherein the rent goes on increasing. Salaries, yes, it is. We live in a world of inflation, so salaries are going to increase every year. People get promoted. There is a specific pay structure in banking industry, because of which I have to pay my employees even more every passing year. There won't be a huge gap. Okay, it might be a difference of say 1,000 or 2,000 rupees, but again, provisioning it for one employee every year, and like that, we have approximately 35,000 employees in Central Bank of India alone. So you can imagine the amount of money, the huge amount of money that we require just to pay salaries, just to pay rent, just to look after utility bills of electricity. There are municipal taxes. There are certain regulatory mandatory amounts. There is insurance, DICGC insurance on your deposit that you keep with us. Okay, so we have to pay a premium for that as well. All right, upkeep of branches, maintenance of records, every small thing. Okay, that I have to pay from my pocket. Now, what is happening is my earning as a branch, as a bank, has gone down, but my expenses, they are never going to come down. They are always going to go up. In this case, what happens is I have to start asking capital. I have to start asking capital from my regulator. This is besides those 60, 70 rupees that I've kept with them. Okay. That is there with them. Besides that, they have to issue me fresh capital. That is the reason past couple of years, past 5 to 7 years, we have been listening every budget. Finance minister, honorable finance minister announces that we are going to give certain 1,000 crores to this bank, certain 100 crores to this bank. This is what the regulatory capital is. When bad loans start mounting in, okay, onto the banking system, provisioning increases, the salaries, rent, this thing won't go down. So we'll have to ask for fresh money. The fresh capital is required solely for the purpose of giving out loans, because only if I give out more loans, more good quality loans, more loans to people who have the intention of paying back regularly, only then I can see some stress lighten on my pocket. I can see some good money coming in, flowing into my pocket. This basically is the traditional banking model. Okay. Now, when I say 3 people have said that, okay, I won't be able to pay the money, this is in normal circumstances. All right. Past 2 years, we all have known since December 2019, when the virus was first discovered in India. First 3 months, we all took it as casually. We thought that this would be like a flu. It would just come and pass by. And because we are like, our lifestyle involves use of specific spices, specific herbs, or our lifestyle. We work out, we practice yoga. Because of that, we won't be affected because of this particular virus. It won't have that impact. But the exact reverse thing happened. March 2020, we had to go into lockdown, which extended for like 3 to 3.5 months. After that, our unlock started. We had couple of phases of unlock. By December 2020, we were all thinking that, okay, this is over, we are done with it, nothing is going to happen. Then comes in the second wave. Okay, it again lasted for 3 to 4 months. Every year, if you see, there's a specific pattern. It starts somewhere around Jan Feb, it peaks in March, and then right through the first quarter of the financial year, April, May, June, we are all engulfed with COVID-19. Okay, although discovered in COVID-19, it has remained with us 2020, it has remained with us in 2021, and unfortunately, we are at the brink of the third wave right now. Now, as an individual, it affects you, it affects your family. Okay, and economically, it is affecting the country as well. The reason being, what happened in first lockdown, for first 3 months, okay, there were only people with essential services. Only those people were on road, only those people were allowed to work, to get their jobs done. People whose, what you can say, industry or the workforce that they were working with, okay, if they were tech enabled, if they were a technologically savvy company, okay, they could get if they could get their work extracted from people who are in at remote locations. Something which was not very popular in India started, which is work from home. Few people, they were not allowed to work from home because their services were essential services. They had to be on that particular job, okay, to be there. just to work and just to keep things in flow, things going on smoothly. We must have seen a couple of apocalyptic movies. I would not like to name a few, but we would have definitely seen a scenario. We would have come across a scenario in a book or in a movie, okay, wherein essential workers are not on their places, and then you run out of electricity, you run out of petrol at petrol pumps, gas at gas stations. You don't have water supply coming in, okay. So in order to prevent that from happening, in order to prevent this situation from turning into a chaos, government ensure that people with certain sectors named as essential services be on their job 24/7, either in shifts, either with minimum attendance, following all the code protocols, but they had to be on the job. Now this sector, okay, basically were central government services, state government services, PSU, public sector undertakings like banks, insurances companies. Then you had gas companies, your ONGC, BPCL, those kind of companies. Telecommunication companies, BSNL, MTNL, they had to be on job round the clock, because we might not be seeing their names on day-to-day basis. We might not be seeing advertisements about them, but they are backbone of the company, of this country still, and they will be as long as we have public sector. There's something called as public sector in existence. These companies will always be essential services, and they would have to work round the clock just to maintain stability into the system, okay, and prevent things from falling into a chaos. This happened with the government sector with PSUs. We are done with that. Certain essential sectors, IT and IT enabled services, ITES, they completely went into work from home mode. Okay, so even they had their working going on. In this scenario, what happened is people were continued to get their salaries. Some received lower salaries than what they were receiving, 90% of the monthly salary, 80% of the monthly salary, because they were not allowed to go out. They had to work for less number of hours. Okay. Certain allowances, that those are linked with traveling allowances, with your working allowances, or certain kind of entertainment allowances also given in certain industries. Everything came to a halt. Why? Because working from home, you need not travel anywhere. Working from home, you need not meet any client anywhere outside besides meeting them online, the way we are meeting right now. Other than this, there were no other external expenses that were required, which were earlier compulsory in day-to-day life. Right now, they were not required. So companies stopped paying those allowances. So people were getting money, but reduced money. All right. There is a huge chunk of unorganized employees in this country. Okay, they amount to somewhere around 35 to 40 crore people. What happens when suddenly one day your organization, your company calls you and says need not come? As a student, you might feel very relieved that you don't have to attend physical college, or you don't have to be at a place, to attend somewhere. But besides students, besides people who are dependent on some organization, think about those people who are living hand to mouth. Think about those people who worked in unorganized sector. Okay, they were suddenly asked to stop their jobs. And in unorganized sector, it is such that people receive money on a daily, weekly, or fortnightly basis. Okay, they have salaries every 15 days. Even in our organization, even in our university, we have people who get salaries every 15 days. Okay, certain section of unorganized workers, okay, unorganized laborers or casual laborers, as we tell them, their only means of income is the job that they're doing presently, and whatever they earn daily, weekly, or fortnightly, that becomes their means of consumption. Okay, now I'd like to pause for a minute. All right, sorry for the interruption. Now, those people, okay, their flow of income stopped. We, being a country, we are the only country second to China, or almost at par with China, who has this concept of savings. Rest, entire world, nowhere money is saved. They invest. They invest thinking that it will double, quadruple, or it will, go 10 times down the line. But that seldom happens. That does not happen with every person. Every 100 investors, out of every 100 investors, 90 to 95 lose their money, or maybe are brought back to the stage, okay, where they were earlier were. Like when they invested, whatever amount they invested with, they're back to that amount only. Okay, they haven't, increased their what you can say, profitability, or got rich. That never happens. The other people, okay, savings saved India in the first wave. Okay, but what the government did was they allowed people for 6 months, okay, a moratorium of 6 months on every possible loan, okay, although with certain regulatory requirements. All right, your loan had to be good for the past say 6 months, or before COVID started, for past 1 year, your loan had to be very regular, very specific. Your EMIs to be paid on time. Basically, your credit standing, your credit rating with the organization, with the banking company that you're banking with, had to be precise, had to be pristine and very clear. Only then those people were allowed moratorium. They were allowed to not repay loans for 6 months. Okay, there was an option you could keep on paying the loan. Okay, that was also allowed. But those people who paid the loan regularly, even in times of COVID, they were allowed ex gratia amount, which means a certain difference in interest rate that was applied and interest rate that was given as rebate. A difference of that amount was supposed to be credited to those individuals who were in a position to pay the loans. Okay, to keep the economy running. The At the start of the webinar, I had mentioned with the 100 rupee example, okay, that what happens when people stop paying me loans. Okay, my regulatory requirement goes up, everything goes up. In this case, what happened is when the moratorium was announced in first lockdown, subsequently it was extended to the second lockdown also, because the second wave was more deadlier than the first wave. All right, and what happens is, who are the people who are getting infected? Those who are going outside. And why were they going outside? Were they going outside for strolling? Were they going outside for enjoying a movie or something? No, they were going out for getting their daily bread and butter. Those were the people that were getting infected. And when you have such people get infected, um, the thing that happens is, uh, they sometimes, or not sometimes, I would say 90% of the time, they are the sole bread earners of the family. In that case, when your bread earner is no longer there, okay, you find it difficult to run your day-to-day household expenses, let alone pay your EMIs. Your EMIs are your last concern in that case, right? So for them, moratorium was allowed. But what the government said was that every account for which you provide moratorium, for which you provide relief because of COVID-19 for 6 months, for 9 months, for 12 months, you provision additional 15%. You provision additional 5%. This was according to every loan type. So for every person, every retail loan, every education loan, every housing loan that we provided moratorium for, I as a bank, we as a bank provided it for, we had to provision the amount of moratorium that we had, not the length of the moratorium, the amount that was provisioned, that was allowed, 6 EMIs. If I say someone, you are not supposed to get 6 EMIs for next 6 months, and you start from the seventh month onwards, okay, that amount that was I was expected to receive in those 6 months, I had to keep a provision on that particular amount also, in addition to the standard provision of 0.25%, which I had discussed earlier with you. Okay, now people who had undertaken moratorium, they had completely lost their job, they were devastated in their lives, they could not repay the loans. In that case, seventh month onwards, those loans started getting bad. Okay, government extended each and every kind of support to them through banks, through financial institutions. We tried our best, everyone tried their best, but some loans, some people, they were just not in a position. Whatever they were, their earnings were, they had completely dried up, because those 6 months people were hardly going out. We were scared to death, even though sitting inside our homes. We ordered essentials, and I'm sure, I won't say this off the record, but everyone paid a premium just to get services. I hope everyone agrees with that. We all paid extra money just to get certain supplies to us delivered to our home. Delivery charges were there earlier. They were there. They were doubled. They were tripled. At times, when you had to get certain commodities into your home, you had to pay like half the amount of what the commodities worth just to get it delivered to your home. Black marketing started. Inflation shot through the roof. Those 6 months of March 20 to September 2020 will be recorded as COVID period, first COVID wave in the history of the country. But in the economical history, that was the darkest period, because we as individuals, everyone have paid out of our pockets, have paid out of our noses just to get things delivered. That has again dried up all our savings. People have stopped paying loans. The traditional banking model was shaken to the core, basically. And after that, this was happened with retail individuals, corporates, MSMEs, people who were employing other people. Those people also had to be given reliefs. So this same facility was extended to them also. In that case, now when all of these things are happening, okay, the burden on the banking industry, the financial pressure on the banking industry has gone up, and this has happened for the past 2 years in continuation. Now on the brink of the third wave, recently, like day before yesterday, Honorable Finance Minister had a webinar. She had an interaction with the chiefs, the MDs and CEOs of all private and public sector banks in India. She wanted to gauge that with the onset of the third wave, how much safe are we as a banking industry, as a finance industry, uh, to prevent disruptions, to prevent disruption of services, to prevent disruptions of banking activities, to prevent disruptions of providing loans to people. Because down the line, now we have become used to work from home. Certain individuals have become used to work from home. Certain who people who have been vaccinated with 2 doses, they have been allowed to work full on a full-time basis, or their attendance is no longer like required to be 50% or so. They don't have to work alternate days. They have to work continuously now. Okay. So what is expected is minimal disruption. Since this particular virus right now, I'm not what you can say, a statistician to comment. I'm not even a healthcare worker. I'm not a doctor to comment on the severity of the virus. But from the reports that we are being fed by the media, this seems to be a variant with less infection, more transmissibility, but less chances of people going into the ICU, going on oxygen and everything. The reason for bringing this into our today this particular topic into today's webinar is because eventually down the line, when we will reach the peak in January or Feb, certain restrictions would have been put as far as banking hours are concerned, as far as number of people allowed into the branches are being concerned. What happens when you don't walk into a branch? Being a student, you would walk into a branch for your getting your passbook updated, getting your debit cards, or getting some amount transferred, making some inquiries. Other people who are working, okay, who have been allowed to step out of their houses to work, basically were essential workers, the people who I named earlier at the start of the webinar, they would be out to get some loans. Because what we have understood as individuals, basically individuals, what happens is down the line, when they're used to something, they learn how to live, we learn how to adapt. That is how we have come here. We have reached this stage out of, say, like 1 or 2 lakh years of evolution. We have reached here because we have never stopped. We have always learned to adapt. We have adapted to this virus also, we have adapted to this lifestyle also. Okay. So that is basically the reason that we want people to walk into the branches. Because certain people, when they'll ask for loans, only then I can gauge them whether their repayment capacity, over the repayment capacity and everything, and then I can decide whether to give them a loan or not. Because like I said at the start of the webinar, the cycle needs to be running. The wheel needs to be running. It needs to be in motion. The moment it stops, everything goes back. Everything rolls back to square one, to the spot where we all started. Okay. In this case, we cannot allow the one bank to collapse. For that matter, any be it any bank, private sector, public sector, it doesn't matter. We cannot allow one bank to collapse, because that will be a domino effect. Every bank and every transaction is linked to every other, to some other banking or financial institution. Okay, into banking. All right. Um, so the traditional banking model has been disrupted. Like I said, we have known what a repayment, when it stops, what happens to a bank, to a financial institution when a repayment stops. Okay, we have been through this. Now regulations are increasing in your life, in personal life. Okay, and as far as financial life of Indians are concerned, regulations are increasing in that also. Like I've said, government is asking to provision more, because what has happened is, first wave we gave moratorium to someone, second wave we extended something called as ECLGS, emergency guaranteed credit line scheme, to every MSME, every what you can say organization out there, those who were employing people. Okay, they had to be saved as well. Our MSMEs are the backbone of this country. Okay, it is not just retail loans. People who work for them, they consume retail loans, they consume education, housing, vehicle, gold. you know for them to pay their money, their employer needs to have money. So we extended a credit line to them also. But what has happened is, the first wave's moratorium, that relief is mounting on us. It is already there on us. Not everyone has paid off the moratorium that we allowed to them for the first 6 months, and in the first wave. Second wave, when there were less of what you can say, a retail relief given to retail loans given to individuals, rather than given to corporates and industrialists. We had to give them relief more, because when you see on a global scale, when you see on a larger scale, when you see this model from a distance, from afar, you come to understand that people who give employment need to be saved more than people who are employed. I'll repeat myself again. People who employ others, the employers, okay, they need to be saved more, okay, in order to save the employees. We are with the employees, the government is with the employees, the banks are with the employees. That is not an issue. But if there is someone to look for, okay, if I am looking at someone, if my bank tomorrow stops my salary, okay, then you imagine what is going to happen. Okay, for that the government has to save my bank, or for any banking institution, any industrialist, any corporate, for that matter. Okay, profits and what you can say, their earnings which have gone through the roof, their profits which have gone through the roof. Okay, that is a separate scenario that comes, with your decoration of the balance sheet. We are not going into that. Okay, uh, for saving industrialists, okay, we had to give them loans. Now, 2 long years, this pressure has been mounting on us. Third wave, something will be coming, definitely, for sure. A relief to individuals, a relief to industrialists, to corporates. Again, that is, I'm not in a position to comment right now because nothing has come, no circular has come till date, okay, right now, for that. But from what I can, from the experience of the past 2 waves, what I can say is that something will be offered. Something will be offered to everyone, to individual and common person and industrialist alike. Okay, which will help in keeping the banking industry the way it is, the economic health of the country. Okay, although we are, I won't say on the verge, but we are very near, not to a complete collapse, but to get into trouble. Indian economy is resilient. It is far more safe from being from collapsing. In fact, today morning around about 11:30 or 12, I just read somewhere. Okay, the Economic Times quoted that we are a 3.1 trillion US dollar economy now, globally fifth largest, and touted to be in Asia's second and world's third largest economy by 2030. Even and the economists, the analysts who have predicted this, okay, they have taken into consideration all the factors, right, from the first COVID wave of 2020 to the way banking is going to be, okay, down the line. So I'll just do a short recap. So we talked about traditional banking model. We talked about what happens if people stop paying loans. Then we talked about how COVID entered our lives and disrupted everything. Okay. Now that we are into COVID, okay, no one knows when it is going to end. No one knows what it is going to be down the line. Okay, but we'll focus on something, what after COVID. We have learned to live with it. Okay, we have learned to sanitize our hands every 10-15 minutes. We have learned to wear mask. Second wave was with double mask. Okay, right now there are no guidelines, but everyone is saying, okay, go for N95 or go for double mask, and this might save you from the third wave as well. Okay, so we have learned to live with it. We have learned to adapt. Okay, going forward, what we have to do is we have to minimize our what you can say, interaction points. All right, we cannot stop going out for essentials. We have to buy daily vegetables. We have to get a daily supplies. All right, so something we can do is we can stop interacting, physically at places where it is not required. One of those places is banking. What I can assure you as a banker is 60% of the things that you want to do after coming into a branch are available online. Okay. Not many people are aware, not many people are enlightened about this, not many people advertise, not many bankers advertise as well, but you can apply for a loan, okay, at from your home itself, be it a vehicle loan, be it a personal loan, any kind of loan that you require, even an education loan, okay, you can apply at the comfort of your home. You all you need to have is you there is basically a checklist of things that you need to be prepared with, basically, first, and you can apply from the comfort of your home. Okay, you can, account opening has already started online. All right, so the basic things about deposits, deposit making, FDs making, you can make fixed deposit online. You can also liquidate them online. You can, and one phenomena that I would really like to touch in this webinar is everyone, almost everyone, I can assure myself, has got into share trading these days. Okay, has opened demat accounts. So my point is, when a person could be that tech savvy, okay, to go into trading of anything, all right, on the share market. So basically, they can also be enlightened enough to take help of banking services, and to help us all out, UPI module, okay, by NPCI, by Government of India, has been a pioneer. It has helped us a lot in our day-to-day activities. We never imagined that we would be scanning, something in a square, and we'll be paying money to everyone. We never imagined that, but that has been made possible by UPI. Now going forward, we UPI NPCI has come up with offline payment. RBI has capped it to 200 rupees. So up to 200 rupees, you can pay anyone offline without internet through UPI again. Okay. Going forward, that will be scaled as well. It will be scaled up in terms of amount. Okay. And uh, post COVID, banking will be digital. Okay. The pressure on present banks in India is mounting due to n number of reasons. Earlier also there were lots of bad loans, lots of NPAs. We had to provision for that. Okay, when we go out into say NCLT, or when we go out into law tribunals to get our money back, out of every 100 rupees we have lent, the experience has been that averagely 40 rupees is we have to let go of, or 50 rupees we have to let go of. Okay, as a write-off, as a haircut, and what we end up with after everything is has ended, after the case has ended, after the loan account is shut, we, after every 100 rupees that we have loaned out, we only get 40 rupees or 30 rupees. Okay, this is about the loans in past 10 years. Past 2 years, the loans which we have not allowed to turn bad, okay, they are setting like a ticking time bomb. All right, although covered with every kind of what you can say, safety cover that we could provide, that the government could provide, that the banks could provide, but still they are a ticking time bomb. That pressure is also again mounting. The traditional banking model right now, the traditional banking model is, it is outstretched. It is outstretched itself. It has gone on the brink that any point could be a tipping point. If the government stops intervening, if people stop repaying, if everything turns into chaos, the first thing that would fall will be the banking model in India. Okay, but like I said, we have all learned to adapt with it. We have all learned to live with this virus right now. So we have been shifting to traditional from traditional banking to online banking. All right, be it eKYC, be it video KYC, we have been started doing that post COVID. Video KYC, eKYC, these are not new concept. RBI comes out with a forecast, a 3-year forecast every year. Okay, like 3 years down the line, what would be the banking model? What would be the business model for banks in India? How payment systems are going to change? Okay, how account opening is going to change? How loan delivery system is going to change? What are the things that bankers have to look out for when they are, say, opening deposits, giving out loans, or just interacting with financial interaction with a person, with any individual for that matter? They come out with a forecast for 3 years. Okay, and that is being done every year. Every year their forecast changes. Okay, so video KYC, eKYC, that was somewhere in store way back from 2016, 17, 18. They had been consistently saying that now what we have to do is, being a nation of 135 crore plus people, we cannot expect everyone to come to banks. We cannot expect branches to have so many staff to attend to people. So eventually we will shift to eKYC, electronic KYC. Okay, and for that purpose they started with CKYCR, which is central KYC registry. Okay, all of the documents that you submit in banks, for past 2 years we have been scanning them, and we have been uploading them to a particular government portal. Government assigns a number to it, which is a CKYCR number. Okay, and if you see, if you are a customer of my bank, you would have seen a CKYCR number is printed on your passbook at the very top, just beneath your account number. If say after my bank you go to a mutual fund or to a financial institution, say an insurance, okay, and they ask for your documents, you can simply give in that CKYCR number, and they can fetch what documents we had uploaded on your behalf, the one that you submitted to us, for which that CKYCR number was allotted to you. Okay, this was supposed to come like 3 or 4 years before, but COVID has made us a preponed. Okay, we, banking institutions and everyone basically now have to scan whatever was submitted to them by their customer and get a number registered to it. And in future it will be linked to all of your accounts. Okay, with insurance companies, with mutual funds, with your share trading platforms everywhere. Okay, so that one person will have only one CKYC number, and all you have to do is you have to keep on updating it. Wherever you have a new address, update it. Whenever you have a new say if your PAN card is old, worn out, you get a new PAN card, updated. Your driving license address changes, your state change, you migrate from one place to other in India, throughout India, anywhere, you update it under that CKYC only. Right now the number is dynamic. It can be different for because since before this, You had insurance, you had mutual funds, you had share trading, you had bank accounts, you had bank accounts in different banks. Okay, so every bank would have uploaded something from there. So right now there are multiple CKYCR number for one individual. Eventually down the line, it will be brought down to one only, like one single number only. All right. Since Aadhaar is already linked to say 90-95% of bank accounts in India, to the number of people who have bank accounts in India, out of which 95% have already linked their accounts to Aadhaar. So we already have one common number. Eventually, CKYCR number will also be linked to it. Okay, this will also help you out when you will be applying for loan down the line, 3 or 4 years down the line. Things will be such that you won't have to carry any physical copies anywhere. All right. Although there are some debates, okay, between the regulators itself, between the government and the RBI and the other regulatory bodies and authorities, that India, being a country of more than 130 crore people, digitization was always challenging for us, beat any sector. That is the reason when computers came in, the first industry that was chosen, to be computerized was banking industry, because financial records, when they went into the computer, when they went online, that was the time people started believing like, okay, now since financial records are being digitized, other things can be digitized as well. Then we had digital governance from state governments, from central government, and so on. COVID-19, as a banker, the opportunity that I see in it, okay, is it can usher in a new era of digital banking when we'll be over with it. Eventually, this COVID thing will turn down, it will tune itself down to just a normal flu. All right. And say 3 or 4 years down the line, post COVID era, or maybe 6 months down the line as well, what we can see is less visits to branches, okay, and more interaction online through your home. Now, one thing that has to be, as a customer, you might be feeling, sir, ye nahi chalta hai, sir, wo nahi chalta hai. I have this bank's account. For some banks, some feature is working. For one bank, other feature is working. You might be having multiple bank accounts, but like understand one thing: being a country of 130 crore people, 135 crore people, out of which, if I leave out the infants and the adults and the super senior and senior citizens, okay, people who are beyond 85 in age or 75 in age, even if I leave that, my working population chunk comes out to 70 to 80 crore people approximately, out of which the unorganized sector, the people whom I mentioned earlier, okay, who live hand to mouth, who earn their daily bread every day, every single day, every week, every fortnight, every 14 days, they amount to half of this workforce. Or more, I would even go ahead and say they amount to more than 60% of this working workforce of 70 to 80 crore Indians. To keep data of all these people intact and make it accessible online to everyone, because your data, your Aadhaar, okay, your fingerprint is being accessed by your digital fingerprint is being accessed by anyone and everyone across the country. So to keep things up and running all the time has been a challenge in India, and it will be challenging. The only reason, okay, that digital banking has been so successful in developed countries or other countries besides India is because, see their population and see our population. You can just compare. There are like 190 odd countries in this world whose population is a fraction of our population. So digital banking or digitization, a digital way of life, digital mode might just be as easy for them, okay, as it is difficult for us. So somewhere down the line, out of 10 people who are banking digitally in India, one or two people might have to face certain constraints or might have to face certain issues with banking. All right, but I'm sure the 8 or 9 people or 7 or 8 people who are working, okay, they would definitely be satisfied with all the workings, all the things that they're going to do online. Certain things like what you can say, certain things they require physical presence in bank branches, okay, or in financial institutions, in banking or financial, any financial institutions for that matter. They require a physical presence for which you will have to be present in branches. But 4 to 5 years down the line, I'm sure even that would have gone online with the advent of video KYC. Right now, video KYC is only being done and recorded at server level, at our main server level. We are yet to start with it. Our bank is yet to start with it, but other banks who have already started it, it is not integrated with the daily day-to-day system that I'm using. In fact, our system is not integrated to the internet as well. It works on intranet. We have our own internet, Okay, every bank has it. Every bank and institution has it in India. They work on their own intranet, not internet, and we are not connected online. Whatever facilities you are able to see online, that is a certain, what you can say, a certain pool of data of our customers, which we have made accessible online, which we have made available online. Okay, so there's an online server for internet banking, online server for mobile banking, okay, and an online server for UPI, for which all banks are connected, thanks to NPCI and RBI for that. But down the line, when video KYC and when all these digital things will be integrated into our system, okay, I feel I'm very much confident about this, that 3 or 4 years down the line, you won't have to come to branch to sign anything. Your loan documents would be executed right from the place where you are. Okay. Already right now, those who are filing ITRs or those who have seen their siblings, their parents or brothers and mothers and fathers filing ITRs, there is something called as an Aadhaar OTP. Okay, you don't have to give a fingerprint, but if your mobile number is linked to your Aadhaar, you get an OTP which you enter into the income tax website just to verify your return. That is e-verification of the return. So this complete module is kind of a, say, a precursor. It's a pilot module of what is about to come in future. Going down the line, okay, you might also be asked to video KYC yourself on income tax portal, okay, just to make sure that you're the same person who is submitting, you know, your income tax return, or some unauthorized person like a chartered accountant who is filing on your behalf. Okay, like they are the authorized people to file return on your behalf. So down the line, physical presence at the branch, okay, will be required to be at bare minimum. Branches will also get compact. They won't be, it won't be with a huge space or something that used to see earlier. Okay, paper dependency on paper, on production of paper evidences, material evidences, like we say, like we have KYCs and everything. That will be, you know, it would be brought down to what you can say, a considerably low level, negligible level. They cannot be completely wiped off from the banking industry, but it will be brought down definitely. Another thing, post COVID, what is happening is 2 weeks ago, 2 weeks ago, if you if anyone would have read, if you guys are, you know, avid readers, or if you follow newspaper articles, uh, there was something about loan sharks are basically app based credit providing companies that have come up. Okay, we are moving into the final phase of this webinar, where I'll be discussing basically on the new entrants, the new people, new industries, new institutions that have come up, that have challenged this traditional banking module. Okay, they are completely digital, they're completely digitized. The best example can be Paytm. Okay, or any wallet based app, just like Paytm. Okay, they take your PAN, they take your Aadhaar, they'll ask you to click photos of yourself with your PAN or Aadhaar, holding it, you know, somewhere like this. Okay, they might also ask you to write a particular code on a paper and get your selfie holding that code, so that that becomes a part of their video KYC, or becomes a part of their digital onboarding process. The what we specifically call it in banking terminologies. RBI banned right about 600 to 700 of these apps. The reason being, start of the webinar, I had informed you that the maximum I can charge someone is on interest, okay, on a loan for my organization is somewhere around 10 to 12%, or maybe 13% for that matter. Now, this is what I do. What I charge you, what my bank charges you, is annually. It is compounded annually. The 13% is for the entire year. If you break it every month, the amount you borrow from me, okay, from the bank, will be basically charged at 1.5% or 1.7%, and cumulative interest can be maximum 13 to 14% in a year. What these loan sharks or apps are doing, okay, they are luring you. They are, you know, what you can say, they are providing you easy credit and asking you to repay back with an enhanced rate of interest. For few of these apps, for few of these fintech companies, financial technology companies, the rate of interest can go as high as 42% a year. We already have a particular product in the market. It's a traditional product which carries 42% interest, and that is credit card. Credit card always had 3.5% per month or 42% per year of credit interest rate, basically. Now, what these financial institutions or new entry apps have done is that they'll take your PAN card, they'll take your Aadhaar card, they'll look out for your credit information score from a credit information company. They'll get your, what you can say, I'll be answering questions if the moderators allow me. Okay, after that, someone just raised the hand, so hold on to your horses. I'll be answering questions. But getting back to the point, These people onboard you digitally. These people take your data, okay, of course with your consent, because you provide them OTP, you provide them access to your PAN card, you enter your Aadhaar card voluntarily, and they'll come up with a credit scheme for you, okay, and they'll provide you the money to your account, okay, and then these people will, what you can say, if you stop repaying or if you have some difficulties, the way you walk into a branch and the way you deal with this such scenario in a banking premises is completely different when you have this thing online. Because remember one thing, when you give these people, hello, yeah, am I audible?
Yes, sir, you're audible.
Okay. My internet connection just fluctuated. So as and when anyone stops listening to me, or if my voice is cracking, just let me know. Okay. Um, what happens is, these people, basically when you install apps, be it irrespective of the OS that you're working on, whether it is Android, whether it is iOS, every app that you install, okay, it's an open secret. Every app that you install on your phone has access to your entire phone, okay, even to your fingerprint. Remember that, even to your fingerprint, and that includes every app. Basically every app, everyone is secretly collecting your data or openly collecting your data, or we ourselves are supplying data to them. So when you stop paying loans to these particular fintech apps, okay, from where you have borrowed, they will go through your contact list. When you have saved someone's number, you basically, we saved your number with the mom one, mom two, if they carry two SIMs, okay, we dad one, dad two, if they carry two SIMs, or just dad or just papa, we name them, okay. These apps, they are powered with AI technology, with artificial intelligence. Even if you save your father or mother's name, okay, like Ma in Hindi or I in Marathi, or mom in Gujarati, whichever language you save it, okay, they will translate those particular contacts. They will take, what you can say, they will look at your call logs. They will take out the frequency of your calls, okay, to a particular number, and they will start calling those people, and they will ask them to force you to pay back your loan. Okay, this is a new kind of vandalism. This is complete vandalism. This is completely outlaw thing that is going on right now in India. Okay, and this has happened only because of COVID, because people lost jobs in the first wave. People couldn't sustain their income in the second wave. They are finding it hard to, live their day-to-day life. That is the reason they went up to these people which got loans with 30,000, 40,000, 50,000 loans. Basically loans which were below 1 lakh rupees. Okay, they had easy access to that, and now they are finding it hard to repay. This is, what you can say, one of the drawbacks of digital banking of post-COVID era. Okay, traditional banks, major banks in India, like I said, they have gone online. You can apply for an account online. You can do certain things online, limited number of things, but you can definitely do those things online. Other than that, you can also apply for loans online. Okay, the only place where you need to like physically visit a branch is when you have to execute the document. That is one of the process. That is the end stage process of a loan life cycle. If you have studied, or if you will be studying it anytime soon, perfection of security and execution of loan documents is when you have to walk into a branch. Okay, that is the only thing. Traditional banks in India have made it possible that you can do everything online and walk into the branch only if some additional information is requested on behalf of you for your loan, or you have to execute documents and create a security charge. Only then you have to enter into the bank. Other than that, in post-COVID era, okay, these loan sharks, what they have done is they have done away with all of these things. You sign everything digitally online through Aadhaar-based OTP, okay, or through OTP which their app sends to you on your mobile, all right, and they will, then run after you. Even if you default one day for your payment, they will be at your doorstep 7 a.m. in the morning. Just to enlighten you all, if you have availed loans of this kind of institution, this kind of apps which give you easy access to loan, it is advisable to pay them beforehand or in advance, because usually, as per RBI, recovery timings in India is from 7 a.m. in the morning to 7 p.m. in the evening. I cannot call anyone, I cannot visit anyone before and after that particular time period unless I have specific consent of the customer. But these people, they can call you in the middle of the night because there is no control, there is no authority over them. That's why RBI have banned around about 650 to 700 apps of these kind. Okay, so just be careful about that. Other than that, there are certain genuine apps also who follow all the guidelines of RBI and who have basically become a threat to the traditional banking model. Okay, new entrance companies, large fintech companies, which have like prominent and reputed people backing them. Okay, prominent industrialists backing them, prominent bankers backing them in India. All right, they are NBFCs. We know, I won't name couple of NBFCs in this webinar. Okay, but we know certain famous NBFCs in India who follow this particular banking module. Okay, they have been into this industry for past 15 or 20 years. All right, and right now they are in a position that they can even become a bank as and when wanted. But like I said, from the start of the webinar, what I've been saying, the constraints, the restrictions, the regulations that you have to follow being a bank in India is way beyond your comprehension. The round about 70 to 80 reports have to be submitted, on a frequencies that starts from daily, weekly, fortnightly, monthly. Okay, we have something called as Friday figures. Every bank has to report the end of the day figures on each Friday to RBI, and eventually RBI compiles all the data, and they also come out with their Friday figure. Okay, so every Friday, if you go to RBI website, or say from any time between Saturday to Monday, they will publish Friday figures. That will be the banking business figures in India, through which they, understand, they come to know that how much of a particular person, has how much of a particular person has a particular bank, has given out credit. What is the total credit output of the industry? What is the total deposit input into the banking industry? Every bank in India has to regulate. So these non-banking financial companies, NBFCs, right now, okay, those are posing challenge to say my bank, or say bank like us, public sector banks or government banks. Okay, they will never focus, or they will never foray into full-fledged banking, because that is where the margin gets tough. Okay, right now, the margin, there is a lot of pressure on the banking industry to give out loans at minimum possible rate of interest. That's why if you see, from traditional BR bank rate, we had shifted to BPLR, base prime lending, benchmark prime lending rate, BPLR. Then we came down to something called as MCLR. Okay, and then right now we are at RBLR. RBLR is basically repo based lending rate. Repo and reverse repo are two terminologies. I believe you must have learned that, or you will be learning that in future. Is basically, at the start of the webinar, when I had said I had to keep certain amount with the government. Okay, and that amount, if it's for example, if it's a 4%, right now the repo rate is 4%. So whatever money I'm putting in, 60 or 70 rupees out of the entire deposit that I have, the government will pay me back, okay, at 4%, right? That is the repo rate. And in also in at the start of the in middle of the seminar, somewhere in the webinar somewhere, I had informed you that if people come to me in large numbers to deposit, to withdraw money, okay, I have to go back to the regulator and ask them for money. Then they loan out the same money that they had given to me. That is the reverse repo rate. That is when I withdraw money from the this thing, from the regulator, from RBI. They will again charge me more on that also. So to maintain these requirements, okay, and to maintain these requirements, what you can say, and the loan that I'm giving out, say if I'm borrowing money at 4%, I'm giving out at 6.85%, there's a very thin margin of 2.85%. And like at the people who have been, joined since earlier, since the start of the webinar, beginning of the webinar, the amount of expenses that I have to make. My expenses are always fixed. The number of expenses, what you can say, the frequency and the amount will go on increasing, but the headings, the heads under which I have to expend, I have to expend that. There is no going back on them. All right. So my margin is very thin. Plus these new NBFCs that have become more aggressive in the market with the launch of digital KYC onboarding process, and digital banking by the government of India, the way they have been promoting it, the way RBI has been promoting it, it has become difficult for the traditional banking institutions in this country to keep a hold of the customers. What I can say is that customer have become so smart that for traditional requirements, they'll go to a traditional banking outlet just like ours or any other bank. And for immediate banking requirements, or for swift banking requirements, they'll go to these NBFCs and the other apps that I have already mentioned to you sometime before. So basically, uh, क्या हो गया है कि what I can say is that my income has gone down. Okay, my expenses have gone through the roof, and there is a very thin line, there is a very thin wire which I have to balance every day and walk. And we are not in a tipping condition. I'm not trying to scare anyone here right now, but economy is not what it looks like. The consumption has gone down drastically. Okay, people are thinking twice or thrice before investing. All right, and when these new companies, government is allowing new companies to come in, basically because more Indians have to be brought under the banking channel. There is something called a shadow banking. in India that is, that has been here, since the start of the banking industry. It's been here for like 80 or 100 years. Shadow banking or parallel banking, as we know it. Then what you can say, there's also been these fintech companies. Fintech companies and NBFCs are nothing but what they have done is initially they had taken a loan from traditional bank like us, and now they are extending loans at higher rate of interest to you. It is the same, what you can say, module, but with a different packaging. All right. So what I charge to them, say if some banking finance company, say a banking finance company has come to me and they have applied for a loan, I'm giving them a loan on, say, like somewhere around 7%. They'll go out into the market. They'll catch hold of customers like you, and they'll give out loan at 10%. Why? Because they have to pay me back at 7%, and they'll charge 10% from you, and that 3% is their margin. So this is how the entire banking industry is only on a thin margin right now. And I guess we are almost up with time. So the way I can conclude this is, like, I'll request everyone to focus more on digital banking, focus more on going out for digital avenues as far as banking and finance is concerned. Infrastructure, but we are getting towards it. It has improved a lot from what we were 10 years ago to what we are now, and we are continuously improving in it. And with the entry of new people, with the entry of new players into the finance industry, okay, things have gotten better for everyone, because the traditional module had to be shaken up somewhere. That is my personal belief. Okay, we had to come out with something new, because people like change. Change is the only constant. Like, as we all know, change is the only thing that is constant. Okay, so entry of new banking companies, entry of new financial institutions into the country, they have ushered in digitization. And I'll request everyone to go digital, because COVID is here to stay. We don't know how long. 19 is gone, 2021 is also gone. We are into 22. Hopefully, it should end by this year. It should, at the end of by the end of this year, it should convert into a normal flu. That's what we'll all hope for. But our access to physical presences in financial institutions, in branches or anywhere outside, ensure minimum physical access to things and go digital, because eventually down the line, this is what is going to happen. Everything is going to turn digital. And I guess with this, I'll conclude. Mansi ma'am, if you have anything to say, or I'm open for questions now.
Thank you so much, sir, for such an interactive and informative session. There's one question from a student, as there are many students who are from banking specialization. So,
Okay.
in coming future, right, like after COVID, what are the skills that are required if at all anyone wants to join this industry?
Okay, first of all, skills. I'll go with basic skills. Okay, you have to be really thorough with all of your terminologies as far as a bank is concerned. Okay, and second thing is patience. You need to have a lot of it. Anyone who walks into a branch or who is on the other side of the counter would realize what patience means. Okay, third thing is you have to be tech savvy. Traditional bankers, those who are retiring right now, okay, or those who are opting for retirement but beforehand, okay, they are finding it very difficult to keep up with the technological advancements, because, like I said, down the line, everything is going to be digital. 5 years down the line, you just simply cannot, expect to call your tech guy every time something goes down into the bank or into your branch. So when you're entering into this industry, make sure your fundamentals are clear about economics, fundamentals are clear about balance sheet, fundamentals are clear about the entire banking industry, the rules, regulations, requirements, what are the controlling factors, okay, as far as the bank is concerned, whose guidelines you will have to follow day in, day out while working on that share. Basically, you have to be very thorough and very clear with this. On top of this, you will need to have specialization in something, because banking, the way, I'll give you some inside information. Banking, the way it is evolving right now in my organization, is that we are coming up with something called a specialist officer post. So earlier it used to be that one person used to look after everything. Now we have a credit portfolio. Now we had a credit monitoring portfolio. We have a forex division, forex hub. Okay, so banking, what I assume, what is being taught and followed in institutions across the country, is the basic banking model, which I spoke about at the start of the webinar. But you will have to specialize in something. Once you finish your graduation, if you're going for post graduation, well and good. Beyond that, I would request everyone or anyone who's looking for a bank job to join IIBF, that is Indian Institute of Banking and Finance. That is basically the institution which conducts exams, okay, across specifications in the banking industry itself. They start with JIIB and CIIB, that is the basic, what you can say, initiation, that is the basic orientation module, okay, for anyone who's not from a banking or finance background. People with banking, finance or commerce background find it very easy to clear those two exams, but going down the line, then you have Moody's, what you can say, credit certificate. Moody's credit certificate will definitely land you a job anywhere in India and on Wall Street as well, because it is famous across Europe, across America, everywhere. So there are n number of certifications that you can go for. What I'll suggest, there is no special skill that you have to learn, but you have to learn everything, and you have to specialize in just one thing. The times are gone when you had to be master of one and you can neglect anything. Now you have to be master of everything, but you need to have that one upskill in one particular section or one particular vast industry. So you can go for forest, you can go for credit, those things, or you can go to HR. HR specialization is also available. Okay, so yeah, that's it. So that will be the.
Thank you so much, sir, for your valuable time. I thank all my dear students and all the faculties for joining the webinar. Have a good day.
Sir.